Okay, welcome back, everybody, to another wonderful lecture. This one's gonna be, we'll try to keep it underneath the half hour. We'll just try to stick to that. So, this specific content right here that you're about to watch is no different from the previous video that I uploaded. It was a deep dive learning on Tesla stock. Basically, what I'm mentioning in that video is where I expect price to go and my understanding of price. So I'm not going to get into that too much. I'm going to get right to this risk disclaimer. So read this over. Really important. That way you understand that there is, in fact, real risk in the marketplace. So if you push the button, that's on you. It's just like going to work. If you choose to act foolish or whatever you want to call it, and you get in trouble, that's on you. So I am not telling you to push the button. I don't encourage it. I'm just here to give you my opinions. So that's all this risk disclaimer is for, because I don't need the police showing up to my house arresting me and rotting in prison. I'm not a bad person, so I don't think I deserve that. So we're going to talk about DoorDash here. So the reason why I talk so much, well, I don't really, but I'm very, very keen on being long on the stock. And when I say long, I mean that I expect it to go higher. So, and another reason is this is actually my full-time job, and I actually enjoy it. Not every single day do I enjoy it, but there is, it's definitely very resourceful, and it's just a way to get me by until trading is becoming my full-time income. So, right here, we have a 3-month chart. So the first thing you're probably going to ask, what the heck is a 3-month chart? So a 3-month chart is basically a candlestick chart that lasts, well, actually, here, how about this? So each candlestick, these are all candlesticks. This is a candlestick, this is a candlestick, this is a candlestick right here. These are all individual candlesticks. So when each of these forms, it takes 3 months. So up here is all the different time frames. So if I switch to a 2-minute, it'll be a 2-minute candlestick. It takes 2 minutes to print a candlestick like this. If I click 2-minute right here, it'll take me to a 2-minute chart. This is a 6-month, 12-month, month, week, day, 6 hour, and it just goes downhill from there. So each candlestick that you're looking at on this chart is 3 months of time. So the most important thing to understand here is this is the ICT Inner Circle Trader 2022 model that I'm kind of teaching. I mean, there's going to be a lot more to it than this, but if you want to go over, this is for a specific, a specific individual that actually helped me out with DoorDash, and I found a lot of success with it. So I'm just showing him and all my viewers this video, so I can help you guys make some money. So the first thing I'm going to talk about is, what is this? 3-month fair value gap. So FWG stands for fair value gap. 3-month is basically, that's a 3-month fair value gap. It appeared on the chart in which each candlestick took 3 months to print. So when I say this fair value gap, what I mean is that we have this candle form. It closes down. This is down closed candle. That means that what prices went down. And then we have the next one opening up 3 months in time. This one also closes down, and then the next one opens up and still closes down. So fair value gap is basically a 3-candle pattern in which the candle in the middle fails to trade back to the previous candle's low. So technically speaking, the fair value gap formed from this candle to this one to this one. So you see this line right here? It's called a wick. So this candle opens up, right here, trades higher. Next one opens up right here, closes lower. Next one opens up, closes lower. But notice how this wick failed to go to this candle's low. That makes that a fair value gap. And I know that probably went right over a lot of people's heads, except for the people that know what I'm talking about. It obviously didn't go over yours. So this is a long-term price target, and so is this one. So this is the same thing. It's a 3-month fair value gap. And the nice thing about this is that I'm able to actually have these typed out because these are price targets for me. So I'm going to get rid of the background here. I don't like that. So we're going to do a gray background. I'm not trying to go for pristine English here. Well, capitalization is what I meant to say by that. But this is here for me. And I expect that within approximately 6 months we'll be up here. I think we're going to reach up here to 133. That's where I think we're going to go. So I'm going to extend this out to January. And this one, I'm going to go with another, we'll say like, let's say another 3 months after that if we're really bullish. But I'm just going to leave it at July of next year. So these are not something that I'm paying attention to short term. Long term, I am. Next, we go down to, oh, actually, I gotta go back. So I'm not going to get into this, but these are my markups. I'm gonna keep it really basic. So I'm going to mark off the open of this up close candle right here. It's green, so that means it closed up. That's just how my up close candles are colored. They're just green. So this is a bearish order block. So that basically means that when price reaches here, you can expect some sort of retracement or lower prices to react off of that. That does not mean that it's just going to go lower. It just means that it can act as a speed bump. Now I'm going to put this right here. That way I have it for my notes. I need to have those for my notes. So we'll call this a bearish order block. And that's what you call it. ICT term, specifically. And then I labeled this as a 3-month. That way I know that it's a 3-month bearish order block. So it's a really high time frame PD array. PD array means premium discount array. Wick, because it's the wick, bearish. I'm going to do plus OB, which stands for order block. It's just a short way of saying it. 3-month. And that just stays right there. And then this one will stay put. But this one's low-hanging fruit. So if you're long-term trading, you're aiming for this, which is 133, 130-ish price range. And the next one moves down to the monthly chart. So I'm not going to go overboard with this because I already have this one right here that's wide open. And I'm not going to relabel that. I'd rather just keep with this one. So right here, that price already, oh, I already have that labeled. So I'm going to slide this over. So this is on the wick specifically, it's not on the body, but the body is the target. So we will call this a monthly order block. Already it's called that, I already have that labeled. So I'm going to change the text to yellow. Wait a second, why do I have it like that? Oh, I have the open. This is the opening price on this candle over here. That's why I have that. this right here is the wick. Monthly order block, OB, wick, right here. Narrow that down a little bit smaller. So I'm just showing you the annotations as I go, but I'm going to get into the brass tacks of this and the most important part. So this wick right here, these are all annotations that are just here for me. So don't pay attention to those too much. The most important part to pay attention to is obviously everything, but the one thing that's going to stand out like a sore thumb is the 2022 model. So I have marked off my, well, actually I haven't. So let me mark these off. I know a lot of you have probably already clicked off the video and said I'm not interested. That's okay. But what I'm marking off here is a weekly imbalance. It's also a fair value gap. Change this to right there. That's beautiful. I like that. You can actually see it. Okay, so this is the same thing I showed earlier. 3-candle pattern. This candle's wick fails to trade to this candle's wick. So it's an imbalanced price range or fair value gap. So let me take a drink here. We'll get into the model. So 2022 model requires a shift in market structure and a fair value gap to form. So a shift in market structure is a 3-candle pattern, just like the fair value gap. There's multiple here, so not all of them are perfect. Some fair value gaps do get traded to and through and don't get respected, and that's okay, because you have to understand a lot more about price action than just looking at a fair value gap, because there's a lot more to it. So when I say a 3-bar pattern, it basically means this candle's high right here is higher than the candle to the left and the candle to the right. When you see that high violated right here with this wick, and you see a fair value gap form, that is your 2022 model, and you're going to target buy-side liquidity. Buy-side liquidity is just basically liquidity that is above old highs and old lows, which is just a short-term high with buy stops or sell stops below. So, for example, this buy side below this old low. Or not buy side, sell side, sorry. Sell side liquidity. There's stops below that. Hedge fund stops, retail stops, whatever you want to call it. There's stops below this. When the market takes those sell stops, they're buying down in here, they're accumulating long positions. And how you know they're doing that is they leave a fair value gap right here. Same thing as right here. Right here. It's right here. Now, this one you'll notice that it actually goes past it. And that's okay, because you have an order block right here. Order block is the last down closed candle prior to the change in the state of delivery. It's a short-term change in the state of delivery. So when we take the short-term high out, create this fair value gap, we have an order block. That's a valid order block. You're going to take your attention right away to the open and the mean threshold. Nice and beefy candle, not really much of a wick to it. You'll take your attention to the mean threshold And the quarter level as well, I like to watch that one, just study it. But the mean threshold is very sensitive. It's a sensitive turning point. As you can see, we never really reached it. If you wanted to use just the body, because there's not much of a wick, you can see that it did actually go through the mean threshold and poked right through it. And that's what you want to see, a reaction off of it. You don't want to see it go through it and boom, go lower. If it's going to go through it, it's likely it's just going to take out that low and it's going to keep going lower. But in this case, it failed to do so. And that's actually what you're looking for, especially when there's buy stops resting above the marketplace. Buy stops are usually an old high or relatively equal highs. So if you see smooth, nice, like flat, equal highs right here, like right here, you have a high and then there's a high right here, really close to each other, and the market just does not go through them, you can expect it to trade down into an order block or a fair value gap and then pierce right through that. Obviously, you need to look at price action a lot more to understand and see that before it happens, but that is how it works. So right here, I'm going to actually annotate the mean threshold here. 46.33 is the price right here, mean threshold, 0.5. It's a fib tool. If you don't know how to use Fibonacci, you just got to keep watching videos. You'll figure it out. It's not that difficult. It's only difficult if you're new. So we'll label this MT, which stands for mean threshold, plus order block. That gets this distracting Fibonacci tool out of my way. So we have our fair value gap right here. Trades through it. That's okay. Our stop will go below this low. So you did not get stopped out. And then your target is an inefficiency or a fair value gap. It's named a lot of things. I promise you'll understand why they're called that. If you go over to ICT, Inner Circle Traders YouTube channel, it will make sense, and you will see it repeat the chart more times than you can count, and then you'll trust it from there. But you need to see it repeat. Just like when you work, your repetition tends to be a thing, and then you notice that you're really good at what you do because you repeatedly do the same things over and over, and you expect things to happen. So the whole key to this is just seeing where it repeats and just taking action from there. When you see it repeats, then you trust it. But until you see that, you are not fit and you are not ready to get into this and start trading. It's just not going to work like that. So we have a fair value gap right here, and ultimately the only thing that I would see if the chart was like right here and these weren't printed yet, I would expect it to trade up into here, this fair value gap right here. So it's hard to see. Let me I don't want to delete these annotations. What the heck is this? Oh, that's my that's where I bought with paper money. This is your inefficiency. So you go right here. Boom. You're buying down in here, right here, and then you're selling your position to these buy stops. So below old lows is sell side. Above old highs is buy side liquidity. So you're offsetting your position by selling above those buy stops right here. And then you're done. Whatever you get, so $45, just save right here. So right when you enter, utilizing the fair value gap. Right here. The top is 50.95 right here to the right. You're buying at 50.95. Your stop is right below this low. So the top left of my screen, where it says the low, 41.37, right up here. The low on this candle, 41.37 up at the top left of, or not, yeah, the top left of your screen. You should see 41.37. That's your stop, and then your entry is, like I said earlier, that 50.95. So, couple dollar stop loss. If you're just trading with stocks, if you're trading with options, it's a lot different. I'm not going to get into that. You'll have to do some research on that on your own. I do teach about that stuff on my YouTube channel, but I'm not going to go into detail. So, your exit is 68. Now, looking at this, that took from this candle right here, from December 2022, the 19th of December, all the way up to February 13th of the following year. So that's like 3 months. Yeah, that's pretty good to me. So I wouldn't complain about that. That's a great return. So, obviously, I'm expecting this to just keep going higher. Like that's not my interest anymore. But as the chart prints, I know where it's likely to go. But right here, to be honest with you, when we were able to print on the monthly chart an order block and a short-term high was violated, that's where I knew we're probably going to be into a buy model. So that basically means that we're going to be trending. The market's going to be trending higher, and we're going to basically, every down close candle is going to be treated as support, and price is going to rip through up close candles like this one. So all these order blocks are going to be like a speed bump, but they're just going to go right through. And when you see it violate the mean threshold, especially with the body, in my opinion, what I've noticed, that is definitely going to go higher. Like, it's going to go right through it, and it's going to trade up to another inefficiency. So, long term, I believe that this stock will reach 160. And then, if we're really bullish, it can get up into 184. And then, obviously, the stock may turn out to be a very great company, like the next Apple, next Amazon. I personally think it's just going to go higher and higher and higher, and it's going to reach a valuation that's justified, like 300 or 480 or 600 and 1,000 and, so on. But it has to show its profitability. This company actually has to do its job correctly, and then we can see that higher price take off. This right here is, I don't care if you know my first and last name, I don't give a shit, but this is my paper trade. So I'm up $100,000. It's not real money. Demo trading is where it's at when you're first starting out. Free resets, and you can actually trade. So I bought right in here. That's my price. $70.56. That's how much I bought it for, and now it's worth $10.03 more. So that's why I'm up $100,000. But like I said, it's just fake money, so it's not real money. I'm gonna leave it at that. Wait a second. So short-term target right here in the middle of this rectangle, about 97 here. That's my short-term target. My long-term targets are up here around 133. And then obviously the one I said earlier, which is right up here, 188. So if you found this insightful, I think I'm going to wrap it up here and call it good. Hopefully you guys learned something from this. And if you would like me to discuss anything in further detail, like any questions or anything like that, I think I'm just going to do a deep dive learning series with all of my favorite stocks, and then I'll just kind of walk you guys through it. So, yeah, I'm going to leave it at that. If you guys have found value in this, smash the like button. Doesn't cost you any money. It's just to show that I'm actually helping you out and you're learning something. So, have a wonderful day, wonderful rest of your week. Looking forward to the weekend, and I wish you well.